Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Eldorado Gold stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. Eldorado Gold is a Canadian company that owns and operates gold mines in Turkey, Greece, and Canada. The company previously developed and operated gold mines in China, Brazil, and Mexico. Its headquarters are in Vancouver, and it's listed on the Toronto Stock Exchange. We are going to look at the ticker that trades on the New York Stock Exchange. Let's get started with the model. This is a small cap company, $2 billion market cap. They're trading at $11 a share, and they have 175 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has negative free cash flow in 2017, 18, and 19, but they do have positive in the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have negative net income in 2017 and 18, positive in 2019 and the trailing 12 months. Their revenue looks really good. It goes from 400 million to over 900 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. And that peaked in the trailing 12 months at close to 300 million. Then below that is operating expenses. Then below that is operating income. They did have negative 43 million of operating income in the trailing 12 months. Sometimes Yahoo Finance doesn't list all the line items, so that's why gross profit minus operating expenses does not equal operating income. Below that is the interest they pay in their debt. Then below that is other income and expenses. Sometimes companies make money or lose money outside of their core operations, and that goes into other income and expenses. Then below that is pre-tax income. Then below that is their taxes. So they did have positive net income, even though they had negative operating income because of the positive 93 million of other income and expenses. So their net income is all over the place. Negative 361 million, positive 81 million, positive 173 million. This company seems to be aggressively growing its business because their revenue is growing a lot, plus it seems like they're putting a lot of money back into the business to grow it. So the result can be volatile net income, as we see. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. That increases a lot each year. Then you have capital expenditures, which are investments in property, plant, and equipment. So you can see the company was investing 200 million to 300 million into their business each year. Operating cash flow minus CapEx gives you your free cash flow. So it looks like in 2017 and 18, they had negative free cash flow because they were investing so much into their business. That investment seems to have paid off because they generated almost $400 million of operating cash flow, which is about 13-14 times as much as 2017. The company issued $41 million of stock in 2019 and $135 million in the trailing 12 months. They needed the money to grow the business because they were operating with negative free cash flow. But it does seem like they're paying down more debt than they're issuing, because they issued $500 million in 2019 and paid down $600 million. The most important part of any business is their operating cash flow. And I think this is a better number to look at than net income, because net income has a lot of accounting things going on. Operating cash flow is the actual cash the company generated. And the way you calculate operating cash flow, you start with net income that was 165 million. Then you have to add back the 230 million of depreciation, because that's an expense on the income statement, but it's a non-cash item. We also have to add back 94 million of deferred taxes. And it looks like they had a positive $79 million of an impairment on their income statement, so we have to subtract that out on the statement of cash flows. So even though the company reported $165 million of profit, they actually generated $380 million of operating cash flow. Like for instance, in 2018, they had negative $379 million of net income, but that's because they had a $449 million asset impairment. An asset impairment is when you reduce the value of an asset on the balance sheet and pass through the loss onto the income statement. Let's look at a capital structure. $3.5 billion of equity, $500 million of debt. They're 87% equity, 13% debt. Their WACC is 8.73%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $4.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.1 billion. We divide that by 175 million shares. And we get a calculated stock price of $24. They're trading at $11, so they're trading at a 53% discount. It's a buy according to the model. Simply Wall Street is even higher than me. They're at $27. So the reason I expect their growth to be large in the future is because they had negative free cash flow in the past because they were investing so much in their business. It seems to be paying off because they had a positive $176 million in trailing 12 months. And if they continue to grow, it might be even larger. But my future free cash flow estimate, I think, is pretty conservative. It looks like the stock peaked at about $25 in 2016. Then it came down to, it looks like, about $7 or $8. It's come back up, but it seems like it's sitting at a great discount. It might take another year or so for investors to realize the value of this company, but the stock price should go up if the company continues to grow. This company has a beta of 1.62, so the stock moves 1.5 times the market. The stock has gone up 51% in the past 52 weeks. That's really good. The S&P 500 went up 18% in the same time frame. The 52-week low was 460, the high was 1450, and the stock is trading below its 200-day and 50-day moving average, so it seems to be on a downtrend. About 2 to 2.5 million shares are traded each day on this stock, and almost all the shares outstanding are on float. 64% of the shares are held by institutions, and a little less than 2% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have about $1,500 today. That's a really bad return on investment. Their largest shareholder is Van Eck at 11%, then BlackRock, then Renaissance Technology, Lansdowne Partners, and the last is Connor Clark and Lund Investment. Let's look at their financial ratios. The average PE in the market's 11.5, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 11.3, so investors are paying about $11 for $1 of earnings. Price of sales is stock price over sales per share. They're at 2.1, better than the median and average. Price to book is stock price over book value per share. They have a great price to book ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $3.5 billion of equity, $3.3 billion of tangible equity, since they have $92 million of goodwill on their balance sheet. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have negative interest coverage ratio. ROE is net income over equity. That's only 5%. Current ratio is current assets over current liabilities. That are 2.0, so they can easily cover their current liabilities. They have current assets of $185 million of cash, $63 million of receivables, and $163 million of inventory. So the company does seem to have enough capital to get through the next 12 months. They had $176 million of free cash flow, $214 million of working capital, and they don't pay a dividend. The best way to look at ratios to compare them to similar companies, I've done videos on Anglo Gold, Franco-Nevada, Barrick, Kinross, Kirkland, Newmont, Oceana, and Gran Colombia, all in the same industry as Eldorado. And if Eldorado has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They're better in all the price multiples. They have a high current ratio, but it's lower than average. The average ROE in the industry is 0%, so they are above average. They're lower than average in debt at 13%. They're a really small company, only $2 billion market cap, much smaller than average, and they don't pay a dividend. Most companies in this industry do pay a dividend. So to summarize, I have them trading at a 53% discount. Their stock price has really come down a lot over the years, and it's really struggled. They seem to be turning things around, so only time will tell if they continue growing and generating positive free cash flow. I did rank their free cash flow 4 out of 10. $176 million is okay, but in the 3 prior years they were negative. Revenue I rank 7 out of 10. It's still below $1 billion, but it's been growing a lot the past few years. They have really good ratios. I rank that 8 out of 10. And their products and brand I rank 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.